Hello, Baker Advanced Financial Planning students. I hope everyone had a great weekend. And we are moving right along because we are in week 5 in a 7-week course. So just keep plugging along. You had a little bit of break last week with the no forum discussion. We're going to pick that up again this week. So we're going to deal with the topics of life insurance, investing, and stocks. So plenty of options out there to discuss any current events. And I'm thinking about maybe holding a Zoom session with you guys. Not that it would be required, but I'm just kind of curious to get your interest in that. Maybe perhaps later in the week, just to touch base, especially to answer any questions of the final project, and just to kind of meet you guys virtually too. So I'd be interested in doing that, but I'll think about what day might work best. Offer it out there and maybe just do it for a half hour, just kind of touch base, get to meet you as the students, and then we'll go from there. So, well, with this week, chapter 13 talks about life insurance, and I have my own philosophies and beliefs about life insurance. It's as I said in previous weeks, you're more likely to be have a disability insurance claim in your lifetime than you will ever file a claim for life insurance. I think one life insurance salesman told me one time that the probability that anybody actually makes a claim on a life insurance policy is 2%. So the companies make a lot of money that write these policies. And, it's kind of one of those things, what if it does happen, so it kind of depends on your situation, where you are in your period of life. I'm more of a fan of term life insurance. That's what I have. I have a policy till age 60. I just took out what I needed to cover. I don't. I kind of believe you don't take out more, again, because the probability that you're ever going to pay off with the life insurance policy. But of course, term does not build any value, but it's at a much lower cost. And that's really, I think, what you're doing is you're just buying insurance in case that 2% probability does happen. There are what we would call whole life policies that build up value. But again, the opportunity cost on these things are so great that if you take your money and invest it in somewhere else, returns on insurance policy, life insurance policies are pitiful. So just I always kind of go philosophy, cover your amount of what you need based on your life situation. If you or your spouse were to die, what would your expenses be? They have different examples. They talk about like an income method, a budget method. There's things like dual income, no kids types of all kinds of methods out there. But what would not be prudent is like to take out $1 million policy, paying a large premium with the likelihood of it never happening, so that you're putting an opportunity cost on yourself when you could be increasing your net worth somewhere else. And I know some people have done that. They've taken out these $1 million policies. They felt good about it, but again, you have to kind of measure probability sometimes, and would your money be invested better somewhere else? Um, so the last thing I'll wrap up with life insurance. One thing I would want you to consider is, what I do is I tend to bundle. I have farmers, so I bundle everything with that. So you usually get economies of scale, lower per unit cost on all your policies, as opposed to piecemealing. Searching out auto policy here, home policy here, life policy here. Best, in my opinion, if you have a reputable, of course, AM Best is the one that rates insurance companies. First, you want to make sure they have a high caliber of quality. They have a large capital that they can make the claims out if they need to, and they've been around for a while and fairly stable. And then you have a reputable agent too that makes sure that person is, you believe that they're selling you what is in your best interest, not to make them a commission. So the last chapters, chapters 14 and 15, for a lot of you, this will be a review. Deals with investing fundamentals, everything from money markets to stocks to bonds to mutual funds, real estate, precious metals. I bought a used car for my son this past week. It was a Kia Sportage. So I did all the research, looked around. I felt like I got a pretty good deal. It was actually somewhere downtown off of Prospect. Met the guy, talked to somebody that I believe that was reputable through my Toyota dealership, and hopefully that car will last for my teenager for a long time. But in terms of one thing I thought interesting, he was telling me even around the area where he lived in Prospect, because they had put a huge police station in that area, Kansas City. He was telling me that $1 million homes are going into that area. So it's really kind of changing. And a lot of people, he had bought land around there and homes in anticipation of an investment. There's no guarantee, but as kind of those that live maybe close to Children's Mercy, don't want to travel far, maybe they're single, might be looking to move in that area. So a lot of these homes were built at the turn of the century, 1900s, and now they're being refurbished or torn down and rebuilt. So it could be a good return on investment for him if it pans out with some of these properties he bought around there. But again, a lot of it is based on that return. How is the economy doing? The markets, we've been following in this course. It really is kind of amazing that they're still doing great. They're at all-time highs. So at least some people in the market, if you believe it's like a crystal ball, are fairly optimistic that this COVID-19 is going to be a temporary blip, and at some point we're going to get back to some more normalcy. So I did see something this week. Even my kid's going to start football this season in high school, so people are becoming a little bit more optimistic. The death rates hopefully will start going down, especially now that more people are wearing masks. So if that is a good sign, if we can get our economy headed back in the right direction, it doesn't mean that certain businesses haven't been impacted by this. But I saw that the movie theaters are going to try to go at it, our local AMC, this month too. So chapter 15, again, gets more specific with stocks or equities. Talks about the different markets, first, secondary markets, New York Stock Exchange, NASDAQ, over-the-counter, use of a broker. When I first came out of college in the 80s, I thought I wanted to be a stockbroker. Today, you just have so much information at your fingertips. I don't know if a broker, unless you're just very wealthy and just want somebody to do that, but I think a lot of you could do this on your own. They're not going to be able to do any better than what you probably could. And I think you guys know my philosophy. Professionals have a hard time beating the S&P 500 mutual fund, and if you were just to put your money on that, it's highly diversified, and over the long run, it was probably given about a 10 or 11% return. So it's a low-cost fund too. To put it in that. So, but there are some individuals that like to buy individual stocks. It is a higher risk when you do that. Going back to William Sharp and the capital asset pricing model and looking at theory, he talked about having a minimum 18 to 20 highly diversified stocks with different betas in your portfolio. If you're going to take that route, you could make a lot of money. Imagine we bought Apple back in the 80s. We'd be on a beach with a frou-frou drink. But that's so hard to predict, that diamond in the rough. There are stocks out there now that are those diamonds in the rough. Are you willing to risk some of your retirement, I'd say any type of investing can also be retirement, but to throw $10,000 at a stock that one day is doing quite well and the next day, because something like COVID hits, is worthless, so that's kind of hard to swallow. But it could also, end up being something very profitable. So it goes back to your risk tolerance. And most of us like to be risk adverse. We try to look at fundamentals. That's what I preach in this course, my past courses. I'm not a big fan of technical analysis. That's where you look at charts and try to analyze those, and it's saying, okay, it's done this in the pattern, so now it's my turn to buy or sell, or put a stop loss order in, or to sell it short. But getting back to the basics, really to me, it's about predicting future cash flows for a company. And I was looking at one for Evergy. I do own a little bit of stock of that in my retirement portfolio. But, it's like, hey, yeah, these analysts were using discounted cash flow analysis, looking to future and, on to infinity. We call perpetuity cash flows. What would that be worth today? And based on what all those cash flows are worth today, you can divide that by the number of shares outstanding and say, yes, this stock is overvalued or undervalued, and make a decision based on that. So, but anyway, so with that, I would just always kind of preach, just use a little bit of caution and just remember that diversify when you're dealing with equities. But you do want it to be some percentage of your portfolio, but especially depending on where you are in your life and your different needs, whether it's for paying for college, providing for retirement income. That's what it is for most of us. Or investing, that would probably be the main thing. But there are some that look to invest just to make short-term gains, to enjoy purchasing other goods and services. So it just kind of depends on the individual situation. So, well, that is it for this week. But otherwise, I hope you have a great week. And if you do have any questions, do email me through the Baker email. But otherwise, I look forward to your forum discussion. Talk to you online. Take care.